Welcome back to Investing Talk Podcast. We're here to help you get well-informed and quickly about the companies driving the current market narrative.
We really try to cut through the noise for you.
Exactly. So you can focus on the signals that truly matter.
And today we're looking at Datadog, a platform that sits right at this really critical intersection of the cloud transition and the emerging AI observability space.
That's a busy intersection.
It is. We've synthesized the latest analysis, all the data points from the street to give you a clear, current perspective on its investment landscape.
Sounds like exactly the kind of intelligence we all need right now.
Yeah.
As usual, before we start, remember to subscribe, like, and comment on this video. It really supports the show.
And it ensures you never miss one of our analyses.
Okay, let's get into it.
We begin, as always, with the fundamentals. I mean, at the end of the day, that's the engine that drives any sustainable long-term growth.
And when you look at the financials, the story for Datadog is, well, it's remarkably compelling, especially in a period where a lot of software companies are, seeing a slowdown.
Deceleration. Yeah.
Right. Looking at the last 12 months, they reported very strong revenue growth of, 26.63%? But I think what's more important is the trend.
The underlying trend. Yeah.
The core business, which is over 90% of their operations, is actually showing accelerating trends that analysts expect to continue straight into 2026.
That growth figure itself is impressive, but what really stands out to me is the structural efficiency built into the Datadog model. You have to look at their gross profit margins.
Okay.
They hover consistently around nearly 80%.
80%. I mean, that is an astounding figure for any business, let alone a growing software company. What does that signal about the health of the platform?
That exceptional margin level is, I think, the clearest sign of platform stickiness. It means that once Datadog is deployed, and it often has to be, deeply integrated, the customer is locked in.
So it's not easy to switch to a competitor.
No. Think of it as the digital equivalent of replumbing a skyscraper. Once Datadog is running that central monitoring and reporting infrastructure, the cost, the risk, and just the sheer effort of ripping that out and replacing it are, well, they're astronomical.
And that lets them cross-sell.
Exactly. This cross-selling into newer categories, from cloud security to incident management, that's what protects that nearly 80% margin.
That makes perfect sense. So with that kind of efficiency, the next question has to be, what does that translate to when we look ahead, particularly in terms of cash generation?
Well, the street consensus is projecting continued financial momentum. Analysts are forecasting a robust 23% compound annual growth rate, or CAGR, for their core revenue.
23%.
And an even higher 25% CAGR for free cash flow, or FCF, and that's spanning from 2025 all the way through 2028.
And what about the immediate term?
For the immediate forecast, the consensus sales target for the current quarter is around $914.55 million. That would represent a 24% jump year over year. I mean, they are printing cash.
They certainly are, and yet they're not really interested in dividends or massive buybacks. It seems like they're reinvesting everything. You mentioned they are projecting something like $4.09 in FCF per share by 2028. Is there any concern that they're overspending on R&D for future projects, maybe missing the mark on what customers actually want today?
That's a fair challenge. They are essentially running an innovation machine, and the market, for the most part, recognizes that this spending is both defensive and offensive at the same time.
How so?
All those FCF proceeds are slated for immediate reinvestment into R&D. They are pouring money into areas like next-gen products, specifically Bits AI SRE, which we should definitely talk about later, and strengthening these critical collaborations with hyperscalers like AWS.
Okay, so the spending is targeted.
Very targeted. And the risk of overspending is mitigated by the fact that they're cash rich. They hold significantly more cash than debt, which ensures immense stability as they fund these aggressive AI-driven growth investments. They have the balance sheet to take these calculated risks.
Stability is key, especially when you're competing with tech giants. So if the hyperscalers, AWS, Google Cloud, Azure are also big in this space, what is Datadog's core protection? What prevents those giants from just undercutting them and stealing that 80% margin business?
The moat comes down to the deep integration and the unified nature of their platform. They really pioneered this idea of unified observability.
What does that mean in simple terms?
In technical terms, we're talking about integrating metrics, logs, and traces, MLT, all together in a single cohesive view that's deeply embedded into enterprise systems.
Could you give us a quick accessible analogy for that MLT concept? Because that jargon can lose people pretty quickly.
Absolutely. Think of it this way. Metrics are the heartbeat. They tell you the system is alive and how fast it's running.
Okay, the vital signs.
Exactly. Logs are the ship's diary. They record every single event, good or bad, with massive detail. And traces are like the satellite tracking the journey. They follow a single user request across dozens of different microservices
And Datadog puts all of that on one screen.
on one unified dashboard. In the complex, emerging AI and cloud environments where rival solutions often lack this crucial unified view, Datadog creates the central nervous system for modern applications. That is its protection against the hyperscalers.
So the complexity of managing a modern application environment actually works as a protective layer for them. That explains the robust fundamentals.
Yeah.
All right, moving beyond the balance sheet, let's look at the short-term signals. What are the charts and the market momentum telling us?
Well, this stock has seen some significant price action, particularly around the $125.49 level. The volatility has been intense, really driven by a battle between the bullish fundamental story we just outlined
Right.
and these conflicting bearish analyst reports that periodically put pressure on the price. The market has been, a little confused about which direction to run.
But there appears to be a major technical signal that suggests a positive resolution to this debate might be building. What's the key breakout catalyst we need to watch?
The defining signal right now is the recent Morgan Stanley upgrade. I mean, that is a weighty piece of institutional action. This upgrade implies a significant 43% potential upside, and they've assigned a target of $180 to the stock.
Wow, 180.
The fact that a firm of that caliber is stepping in now, it signals a kind of psychological shift. If the momentum from accelerating AI demand continues, this is precisely the type of action that can trigger a strong breakout above the current trading levels.
It's not just the number itself, right? It's the institutional validation that matters.
Mm-hmm.
When a Tier 1 bank moves, the smart money typically follows. It suggests they see an inflection point that maybe the bears are missing.
Precisely. That $180 target isn't just a random calculation. It reflects improving underlying growth trends and this accelerating cycle of cloud migration finally hitting its stride. It positions Datadog as a critical infrastructure player.
So let's shift our focus to market perception. Understanding sentiment is vital, especially with a volatile stock like this. Are the bulls or the bears winning the narrative war right now?
Based on a quantitative scoring we've seen, derived from recent market context and headlines, the sentiment is officially, and I'd say, robustly bullish.
I'm bullish, okay.
We saw 4 out of 7 relevant headlines register as either bullish or somewhat bullish, and that's driven largely by the sheer weight given to key analyst actions over the last few weeks.
Let's focus on that biggest piece of news then. Tell us more about the Morgan Stanley move.
Okay, so Morgan Stanley upgraded Datadog to overweight on January 12, 2026. This upgrade came explicitly with that $180 price target, and they cited 3 main factors.
Which were?
Robust cloud growth, accelerating enterprise demand for integrated observability, and significant confidence in the strength of their new product pipeline. Other firms like UBS have followed with equally optimistic endorsements, though maybe a bit less aggressive.
And speaking of that product pipeline, it does seem like they are constantly expanding their toolkit. What specific product developments are generating this level of enthusiasm among analysts?
There are 2 major strategic developments. First, they're expanding collaboration with AWS on new launches that bundle AI, observability, and security features together.
Tightening their relationship with the biggest player.
Exactly. And second, and this is truly futuristic, the introduction of Bits AI SRE.
SRE stands for Site Reliability Engineering. What does autonomous incident resolution mean for, say, a CIO who is paying for this service? Fewer 3 a.m. wake-up calls, I hope.
That is the perfect way to frame it. It means the system is designed to solve its own problems, or at least diagnose and start solutions, before the human team is even paged. It's not just about monitoring.
It's about automated intervention.
Exactly. This drives down recovery time, it maximizes IT team efficiency, and it minimizes human error. It essentially gives enterprises a massive operating efficiency gain, which is why analysts are so excited about its revenue potential.
That sounds like a tremendously powerful cross-sell opportunity, pulling in new clients while deepening ties with existing ones.
It is, and if we connect this to the bigger picture, institutional sentiment generally leans positive right now, largely fueled by this strong consensus of analyst upgrades. The large investors recognize that Datadog isn't just a software vendor anymore.
It's essential infrastructure.
It's essential infrastructure for the next generation of automated, highly distributed computing.
We've established the foundation, the technicals, and the bullish sentiment. Now let's look at the catalyst calendars, understand when this story might accelerate. What's on the immediate horizon?
The calendar points directly to their next major reporting date. Q4 2025 earnings are expected late February or early March 2026.
And the consensus.
The consensus is already eyeing a potential revenue beat, looking for a 24% year-over-year jump based on those continued tailwinds in AI and cloud spending. A strong beat here would validate the recent bullish upgrades and likely fuel the breakout toward that $180 target.
And what about the broader environment? Are the macro conditions helping or hurting this tech growth narrative?
The macro environment is shaping up to be quite favorable for high-growth SaaS. We're seeing increasing expectation for interest rate cuts this year, which typically causes sector rotation back into high-growth AI names like Datadog.
Right. Cheaper money finds its way to growth stocks.
But more profoundly, the accelerating pace of global cloud migrations positions Datadog for what many are calling a second wave of robust demand.
A second wave, what does that entail exactly?
The first wave was just moving data to the cloud. The second wave is about managing the complexity of that data once it's there. And it's about implementing new AI architectures, which are inherently more complex and require real-time auditing and monitoring across disparate systems.
So more complexity means more business for Datadog.
More complexity means a greater non-negotiable need for unified monitoring and security. It places Datadog directly in the path of that spending.
Now, we must turn to the risks. No growth story is without its challenges, and this is where we need to check our assumptions. What's the primary concern that the bears are latching onto?
The top competitive concern is the intensification of competition, particularly from deflationary architectures and open source alternatives that promise lower costs, especially for massive log storage.
And this isn't just a theoretical risk.
Not at all. It was the precise reason Goldman Sachs issued a rare sell rating, assigning a price target of just $113. They fundamentally believe Datadog will lose market share due to pricing pressure.
That's a direct challenge to the high-margin thesis. If they're getting undercut on price by strong open-source offerings, how does Datadog maintain that 80% gross margin and stop customers from defecting?
They have a necessary and aggressive two-pronged strategy to manage this threat. First, they can employ tiered pricing models to maintain competitiveness at different levels.
So offer a cheaper version for basic stuff.
Right. Essentially offer a cheaper version for basic log storage while charging a premium for their core unified intelligence. Second, and this is crucial, they have those massive cash reserves we discussed. They can fund strategic M&A, allowing them to acquire smaller, innovative startups to quickly counter any threats before they gain scale.
So they're using their balance sheet as a competitive weapon to acquire their way out of threats.
Exactly. It's a very effective defense in a fast-moving market.
Let's address one last operational risk. If AI truly accelerates data generation, leading to explosive volumes of data being ingested, could that sheer volume pressure their fantastic 80% margins?
It's a secondary risk, but one the company is certainly aware of. If the only service they provided was simple data storage, yes, the margins would absolutely compress.
But that's not all they do.
Not at all. The existing unified platform's moat and the inherent complexity of managing agentic AI environments that actually helps offset those simple pricing pressures. Companies aren't just paying for storage, they're paying for complexity management, for seamless integration, and for automated resolution with features like Bits AI SRE. That premium for intelligence is sticky.
We've covered the financial depth, the market signals, the upcoming catalysts, and the necessary risks.
Yep.
So when we put all these pieces together, what does the final verdict look like?
The investment thesis is, I think, extremely compelling and concise. Datadog's nearly 80% gross margins and highly reliable 23 to 25% CAGR forecasts position it as the essential unified observability platform. It's necessary for the coming wave of AI agent deployments and ongoing cloud migrations.
And the big analyst calls reinforce that.
They do. The 43% upside potential signaled by recent significant institutional upgrades, specifically from Morgan Stanley, just reinforces its dominant market position.
So that translates into a high conviction narrative. When we synthesize all those points, the financials, the sentiment, the moat, the growth, where does that land our overall confidence?
The final synthesis score lands squarely in the positive camp. The bullish score is 8 out of 10. This suggests a strong thesis for investors seeking long-term growth.
With a caveat.
Yes. Provided you are prepared to navigate the short-term volatility caused by those conflicting analyst calls around that $125 level.
And what's the appropriate holding period for this kind of high-growth story that's so focused on cash flow generation?
Based on the research and those FCF projections, we'd recommend a multi-year hold, specifically targeting the 2028 FCF inflection point when the company is expected to generate that significant free cash flow per share. This is a compounder, not a quick trade. And what's really fascinating here is a potential regulatory dynamic. Future AI governance mandates might actually favor audit-ready, unified platforms like Datadog.
Yes.
Well, if governments or compliance bodies start requiring better auditing and visibility into how AI agents are operating within enterprise systems, that regulatory push could provide an unexpected and powerful tailwind. It would make Datadog even more essential.
That's a great thought to leave with the tailwind. Could raise the floor on their long-term relevance, regardless of short-term market noise. Thank you for joining us for this analysis.
Well, pleasure.
If you found this useful, please hit that subscribe button to catch the next stock we unpack for you. See you next time on Investing Talk Podcast.